And we've got to start with Nike. Those shares are having their worst day ever as a publicly traded company, down 20% after that revenue problem and disappointing guidance. They now expect sales to drop 10% in the current quarter. Ava, are you a buyer?
Nope.
Okay.
It's a sell. Unfortunately, it was once a great entrepreneurial company. Now it's a tired brand. We're speaking about flat growth as of now, and now negative up to 10%, negative 10%, as you mentioned. And most importantly, their profits have come down since COVID. And we are speaking about an area, a category that's traditionally slow. It's a very, very flat industry, very unexciting. Of new upstarts, young companies such as On Running or Hoka, they're taking away market share from Nike. Unfortunately, there's bleak outlook for them in the future. That's what we're predicting.
Wow, a tired brand, Nike. Wow, that is really, that's harsh, Ava. But yeah, good. That's all right. Love when you say so, when you go at it right there. Let's talk about Chewy. That stock dropping just a day after Roaring Kitty's dog post share.
Phrases you never thought you'd have to say.
Roaring Kitty's dog bite. I don't know. Shares had risen as much as 34% following the dog post from Roaring Kitty. What's your trade on Chewy?
I'm buying it. It is a meme stock now at this point, but we actually own it. And there's 20 million shares that are being shorted, but there's plenty of liquidity. Most importantly, what we like is that the stock is well off its highs, its COVID highs. But back then, they were not profitable. Now the company is making money, and its revenue growth is significantly higher than its peers, 7% compared to flat for the rest of the category. And on a relative valuation, they are completely in line. It's exactly on the industry average. And so when you have revenue growth that's higher and you have relative valuation that's in line with peers, and also we're speaking about an industry that we have millennials especially getting more into owning pets, and we saw this trend starting during COVID. I think the outlook is good for them.
People will spend on their pets, that is for sure.
She's jumping on the meme trade. Interesting. Right. For our final name, Ava, we asked you to give us your top pick for the second half. And of all the stocks in all the world, you chose Arista Networks, which has more than doubled in the past year. It's up 49% so far this year. Why is this one a strong buy?
So it's an alternative AI play to companies such as NVIDIA. And what we like about them is that there are many companies speaking about AI. There are many companies claiming that they use AI to improve their margins, but there's not really any evidence when you look at their fundamentals. This is a company that you see margins have improved from 31% to 41% in 4 years. Revenue growth is 25% compared to negative 1% for the category. And the most revealing statistic of all is that their EBITDA growth is 39% compared to negative 10% for the category. So this company, such as NVIDIA, are two of the few examples that we see globally of companies that are able to take all their market share away from their competitors and grow in an exponential way.
Ava, thanks very much. Have a great weekend. We appreciate it.